Well, stocks broke out to another new all-time high today, but that breakout, you put that into some context and wasn't that big of a deal. But we'll take a look at it and see what it means, and see what it means in the broader context of what our posture is, and whether or not that we're going up too much. I know that's been a popular topic in the financial media, so I'm going to break down whether or not we're going up too much and how we would know what kind of patterns we'd see on these different technical indicators, and how much potential we have going into 2020 for another year like this, if not exactly like this, a good trend to the upside. So I'm going to break all that down in today's video. We're also going to take a look at what's driving today's action, with some good, strong moves in some specific areas in the market. And then with today's trade idea, we're going to take a look at a stock that appears to be breaking out itself in a strong sector as it is. And we'll take a look at how we can trade that within the context of what is already a strong bullish market. So let's go ahead and get started. Today is Thursday, December the 19th, 2019. This is the market outlook from marketscholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see here, we have the intermediate line showing us a strong bullish posture. We have the market sentiment showing us a strong long-term trend. We have the near-term line and the momentum line both getting really close to the 80th percentile. So we would have had another cluster, but this one would have had all four lines. We were close on these two with the market sentiment, but this one would have included the market sentiment line. Excuse me. Getting above 80 again. The last time we had that was here in earlier this year in April. We had all four lines up above 80, with the market sentiment up there too. And also keep in mind too that we're coming off of 2 straight weeks on the weekly chart, and we still have the near-term line up here above 80 on the weekly chart. All right, so come back down to the daily chart. You can see we continue to trend really nicely higher here, lacking as I mentioned in the Market Outlook live video that we just did at 3:30 Eastern, or actually in the portfolio management class we talked about today. We're lacking a catalyst to produce people who want to. Let me move the camera down a little bit. There we go. We lack a catalyst that can could spark selling, and no one really wants to sell, and we're getting some buyers, but not to the same extent because we're not moving up very much either. We're just kind of grinding, which is very typical when you're in a low volatility environment like we're in right now. All right, so, and we're also heading into expiration, and a lot of times you'll get one-sided moves heading into expiration because it's a pain trade. People start loading up on one side of the market thinking we might be overbought, so they sell premium on the short side, on the call side, and we keep going up and producing the most pain possible, because that's what markets do. So, but if you take a look at the Russell 2000, it looks a little different. The Russell 2000 has not just been grinding away. It's had a really good week. It's been progressively moving higher every day. Its near-term line is much higher. Market sentiment line, in fact, has finally crossed above 80. It's at 80 and a quarter. So very, very good development from a small cap standpoint. And again, no cluster yet because the momentum line still hasn't popped up since been on a slow grind since that little pop right there that got the momentum line higher. Every other day has just been a grind higher here. So the lows have been getting progressively lower, which is another good sign for the small cap index. It's been underperforming for most of this year. You look at the NASDAQ, it's had a really good day today. A lot of today's gains kind of in that growth area on the NASDAQ came really close itself to a cluster. And then finally the Dow Jones Industrial Average, you can see how close it came to a cluster. It's had all these longer upper shadows here recently, and today kind of a little bit of an intraday breakout above that. Yearly highs across the board for all these major indexes, including the Russell 2000. But keep in mind, that's not an all-time high for the Russell 2000 because it's been lagging for so long since that 1742 high. So we still got some room to go. But you can see lately how, since we popped up above 1600, we had the pullback on the trade-related tweet that mentioned that we might wait on the trade deal till after the election. That produced the return move back down to 1600. and we've been bouncing up ever since, up and through the announcement of said trade deal. So good posture across the board for most of the major indexes. Nothing yet shows that we are extreme. The near term, you can see the near term posture run that we're on took off right here. We're seeing right here, crossed over above 50. So we are 6 days into this current. You can see it better if I zoom in. Here we go. There's where the near-term line crossed above 50. So we got 6 days on this current run, which is typically 7 to 12 days long. So I doubt it's going to end before expiration. But I also don't think it's got a whole lot of upside either. Most of it coming early, as is usually the case. And now we just grind higher until we get the near-term line pulling back down below 50. Keep in mind, we are still this near-term high point here. The near-term line still hasn't gotten above, even though the index itself is way up above. So that divergence, that near-term divergence, is still in play and would set us back if we were to play it out down to the 23% retracement level, which keeps moving higher as you keep moving the high up higher. So now that pullback in the divergence, see over here, the pullback would have been down, but now we've been moving this up. We're looking at a pullback towards a 23% level, which would be right around 31.22, which wasn't a big deal a week ago, but now it's almost a 100-point drop from where we're at. Not that big of a deal, but bigger than what it would have been just a week ago. All right, before we look at some other charts, I want to invite you to subscribe to our YouTube channel. Mouse over our logo right here on the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when these videos are posted. Also, while you're down there, hit the thumbs up icon. That tells us two things. Number one, you liked our video. Number two, you want us to do it again tomorrow. It's our survey that we look at to see whether you like our videos or not and you want us to keep doing them. So just click that if you do, and if you don't have to click anything. While you're down at the bottom, also comment on what stood out to you in today's video. Join our Market Scholars community. There's a link popping out right there on the top right corner of your screen. That takes you to our website where you can join our site for free, get a few perks for free. You can also see all the other things that we offer for our premium subscribers. Follow me on Twitter for more content in between these videos from day to day, and join our Market Outlook Facebook group that we've created. We also invite you to check out our site. If you're watching our Market Outlook here, check out some of these other things that you see on this page, including our Market Outlook live videos I mentioned before. We do those at 3:30 Eastern Time. That's part of our Plus subscription plan. You get access to those videos where we manage all these trade ideas every day that we put them on, all the way to their close. Keep track of them. You also get access to all of 8 of our trading rooms that we do every week. So you can see more details right here. Also, you can see social media down here at the bottom. So we invite you to engage with us on social media. You can just hit this little heart. It opens up this window. You can like today's Market Outlook tweet, click the thumbs up, do the same thing on Facebook. Again, the more you engage with us, the more Twitter and Facebook will promote our content to you because they only promote the content that you like and you engage with. So we try to make that really easy for you here. All right, if you take a look now back at this chart, you can see the weekly chart for the S&P. Very bullish candle. We're closing above last week's high so far. We got one more day left. I'm going to venture to guess tomorrow's going to be a pretty light day, but we'll see. We'll see in the markets. But heading into a holiday next week, don't be surprised things are already slowing down. So keep that in mind. So we'll probably end up getting some smaller bullish candles, at least one more week into this year. Before we head into next year, but still above the rising 50-day moving average, above a rising 200-day moving average, no transition candle yet to worry about. So very, very strong momentum, or we're very strongly positive. We don't typically fall off a cliff when we're this strongly positive without some kind of convergence first. That's not the case. You can see the Russell 2000, how bullish it looks after breaking out here. It's continuing to push up to new highs and increasing in its bullish momentum. So it's still got a lot of room to run to catch up with this large cap peers. One of the reasons why I'm not nearly as bearish in the markets from a long-term perspective. We might be overbought in the short term, but in the long term, I think we're still closer to the beginning of the run than we are the end. All right, now let's take a look at the 3 green arrow chart. And you see that we have 3 green arrows, obviously, and we have a pretty decent jump in volume here, up to 1.5 times the average volume today on SPY on this little bit of a breakout move. Interestingly enough, coming after what could be deemed a negative headline from a market standpoint in terms of the impeachment of a president, of a sitting president, but apparently not an issue to the market. And you can see, too, that we have strong momentum. We're still way up above the 8-day moving average, so we are getting a little closer than what we were. And then the gap, the MACD, is still really high, and is kind of getting another little mini surge I mentioned before. And we're still on the bullish end of that little mini surge. So, I would expect that any pullbacks would be limited to the 8-day and then to the 17-day moving average before we finally get a convergence of these lines that would precede more of a pullback. That would lead to an intermediate pullback on the S&P 500. So, now let's take a look at the, at the intraday chart. Not that one either. Right here. And you can see that we are, above the point of control now is way up here where this week's range has been very tightly coiled. And we broke out above the point of control, so now it's below us acting as support. And you can see where the other layers of support are in the value area, which is almost all in the upper half of the chart. So we've got a really good range between the low and the high, almost to that 5% mark where the rubber band gets stretched. As I mentioned, using that analogy before, you can only pull the rubber band so far before it runs out of room to stretch. And for a bullish market, that tends to be right around that 5% of the high mark when you're looking at the 4-week range. Whereas on the below the lower end of the range, you're looking at about a 10% move from the high. So again, just on a 4-week range. So you can see we're getting there. 323-ish is the range. We're at 321 right now. So we're getting closer and closer to that on the short-term level. You can see how much the volume is tapered off here at the bottom. If you take a look at today's range and volume, so we're at 82 million essentially in the range today, 1.5 points. If you put those numbers into context, 1.5 points is way below the ATR, which is already really low on a 52-week basis. The volume was 81 million, so right here. So we continue to have a little bit of a bump in volume over the past week and a half, sprinkled in with some low volume days as we've had the past couple days. And you see the range, the 1% range, 1% ATR would be 3.2 points. 3.2 is right here. So we are way below that number. That's really bullish. And again, it's hard to fall off a cliff from these levels. So until you start seeing these numbers start to slowly move their way up, and we get more of a kind of gradual pullback, then you start worrying about falling off a cliff. And we're obviously not to that point right now, not anywhere close. The same holds true on the volatility. If you look at the volatility here, here it is. You can see we've been gradually moving higher all week since the open. We've been gradually moving higher in volatility, even as the S&P has moved higher too. So that tells you a little bit about this upward move. It's like, don't put a lot of stock into it. And remember, we are overbought in the short term. We are oversold on volatility in the short term. We're still in the oversold area of the bullish zone. The bullish zone is between 90 and 80. We're still below 85. So we're still in the overbought area, or oversold area, which means that we can get a bump in volatility, and wouldn't that be that big of a deal? It would just be an oversold bounce, which would lead to some kind of near-term pullback on the S&P. But when that happens, it could be tomorrow, it could be Monday, it could be after Christmas. So considering the holiday season and how it tends to have an upward bias anyway on low volumes, barring a catalyst. Last year was the Fed and China trade, and mostly the Fed last year at Christmas time. Well, now we just don't have neither one of those catalysts. So that's why we're really, really quiet, lacking any other catalyst that could spark a much considerable jump higher in volatility. So before we look at what's driving the market in today's trade idea, to summarize our technical outlook, we have a strong bullish trend, strong bullish posture. We've been strongly bullish for a while now. That nothing has changed. We're not euphoric. We're not extremely overbought to where, like January of 18, where we might fall off a cliff at any point. We're not that far up. The tightrope, so to speak, is not that far off the ground. But we're also, we are still overbought in the short term. So that increases the odds, not to 100%, but increases the odds of near-term pullbacks we need to keep an eye on, but nothing that would be trend changing in the least bit. So as we've re-engaged a new bullish momentum surge, just look for small pullbacks in the 8 to 17 day range while we're lacking a catalyst and creating volatility in the markets. Just look for small little overbought pullbacks and continue to grind away with the S&P as long as it trends in this particular direction. So what do you think? Do you agree with that assessment? Do you disagree? There's a link right there popping out in the top right corner of your screen. Click on that link. It opens up a poll. You can hit agree or disagree. If you click disagree, comment down below on why either you're a lot more bullish than I am or more bearish than I am, and share what you're seeing, what indicators, what charts that gives you that opinion. All right, now we take a look at the asset class comparison. You can see since the October 8th low, we've been doing really well. In fact, here's all the equity asset classes and crude oil, all really up pretty big, 5-6%. Now keep in mind, just this 3-month chart when we were at October the 8th was not looking nearly as strong. You're going back to September the 9th or July the 9th. You can see that just going into that low point, we were down 5 or 6%, and gold and long-term bonds were up 8-9.5%. That was a pretty overbought safety trade that we're still in the process here of unwinding. They're down a little bit, but they're not down nearly as much. So we're getting a run on risk, but we're not getting the oversold risk off either. So that kind of gives you an idea that the market still has room for this risk appetite trade to move up. And push the safety asset classes down to much lower levels. Even if you look at like a 9-month chart on this, you can see they're still pretty bullish relative to the S&P 500. So we still have some outperformance of these before we can catch up and really say that we're overbought in the long term, right? So you can see why I'm not so overbought in the long term here. We did have a relatively big economic indicator day today. You can see the Philly Fed survey came out. It was not as strong as expected. In fact, it came down close to break-even levels in terms of contraction versus expansion. So that's a relatively low number. And then you look at existing home sales also out today. You can see the year-over-year change is at 4.2%, revised lower from what it was originally. And then this number was much lower. So the year-over-year rate of existing home sales are starting to slow down too. Now remember, housing is more leading. So it's been pretty bullish. Everything else hasn't been. As you can see on this indicator, we're still at a slight negative number on both of these. So there's still plenty of upside room. And now it looks like real estate, which has been relatively strong, is not necessarily falling, but slowing. From a interest rates standpoint, you can see, again, still no odds whatsoever, 1.1% that we'll get a rate hike at all in 2020. Remember, we didn't have any odds at all of getting rate cuts in 2019 going into December of 2018 either. So, and we ended up with 3 cuts. So keep that in perspective. But you can see going into the year, we still have a dovish tilt. Even if it's only about a 50-50 odds that we'll get a rate cut. But again, it's a 50-50 odds that we'll either get a rate cut or no rate hike, right? So it's not a rate cut or a rate hike. So that's we'd have bigger numbers over here. So still a relatively dovish stance from a market standpoint in terms of what the Fed's going to do into 2020. Relatively dovish. That's not one cut, and even not that much of a likelihood. Is not that dovish, but it leans that direction more than it leans to the hawkish direction, the direction of raising interest rates, which generally leads to these market gains slowing down, if not eventually rolling over. If you look at GDP estimates, which are updated this week, they're growing. So GDP appears to have bottomed and maybe starting to grow its way back to the upside. Slowly but surely. It's not a volatile index, but it's a good sign that we'll get more and more from a macro level of a turnover to the upside, and that generally leads to higher yields and other you can see bonds which haven't really fallen yet. If I go to a long-term chart here, TLT, you can see we're still kind of floating. We haven't broken that 200-day moving average and gotten into a death cross environment, which is what you get when we're in bull markets. So we're not to that point yet. And you can see the same thing with the 10-year yield. The flip side, it hasn't turned positive, which is generally what happens when you're in a bullish market. Again, you can see from the elections of 2016, we took off, and so did the stock market, and then we continued higher all the way through October of 2018, before the stock market peaked and rolled over, and so did yield. So we still have some room for us to be more bullish. Again, this is a typical pattern when you're extreme in your long-term bullishness. This is not a typical pattern when you're extreme in your long-term bullishness. And the other thing too that could spark more of a extended rally in equities and risk appetite as a whole is a breakdown in the dollar. Now, we had a pretty decent move last week to the downside. This week we're not really following through with it yet. So we're going to need to break through this to get the Heikin-Ashi candle, the body of the candle, to break through that low point of 96.60, essentially 58. And again, that would be significant, and that would lead to higher emerging markets. It would lead to higher risk appetite as a whole, and you'll start to see like yields take off and bonds really kind of break through their support. As you can see, bonds, if you look at on the Bollinger base, on the volume profile here, we're kind of in this gap of volume. There's room for it to continue to go down before it finds its next layer of support down this 132 area, which will eventually be after a month or so, because that's where your point of control is right now, down at 121, but that one will probably end up being your point of control here pretty soon. You break through that level, and it's away we go in terms of risk appetite to the upside. All right, and as I mentioned before, when you look at look at this from a foreign perspective, from the 12 grid here, you can see again the broad, light pink shading, but still green lines, yellow line here. That's a very bullish pattern when you have light pink shadings and yellow line. So some pullbacks in the developed space and mainly in the developed space, but look at the bullishness in the emerging markets. It's a very broad rally across all the major economies. Very, very good sign for risk appetite as a whole. Again, another reason why I think we're a lot closer to the beginning of this long-term run, that it will extend into and through 2020 than we are a euphoric end, like a lot of people think we are headed towards, similar to what we saw in January of 18. I don't think we're close to that level yet for a variety of reasons. All right, now let's take a look at the sector moves, and let's go to right here, and you can see how healthcare and financials and technology have been outperforming and doing really well. On the flip side, you can see energy is still struggling. Remember, that's a sector, energy materials, that typically lag, and these two will outperform when we get towards a euphoric end, in some cases, depending upon where the dollar's moving. But look at discretionary still lagging behind. Again, not a sign of euphoric market. And again, as I mentioned before, going into the October 8th low point, just a few months ago, just to remind you of how bullish the safety trade was. That's what it looked like going into September 8th, and again, that's what we look like now. So, and they haven't really pulled back too much. They're still doing pretty well from that October 8th low point. In fact, staples is up, utilities is up, and only real estate's down a little bit. So we haven't really had the sell-off of this really overbought safety trade, even from a U.S. Sector standpoint either. If you take a look at the 12 grid for the sectors, take a look at it right here, you'll see that there's a lot of dark green shading and green lines, even in the energy sector finally. Look at real estate kind of breaking out the last couple of days, joining utilities in a pretty decent run. So we're pretty bullish across the board. Only industrials have been pretty light. And they haven't been bearish, but they've been flattening out with a weak bearish posture. But dark green across the board with green lines, very, very broad rally we're getting right now, not just in the U.S., but globally. Good sign for risk appetite going forward, and still like I said, no signs necessarily of euphoria. Now, that doesn't mean that we can't be vigilant in how we manage risk with smaller trades and less aggressive trades right now because of how overbought we are in the short term, taking advantage of the near-term pullbacks, taking advantage of any intermediate pullbacks that pull the intermediate line down below 80 but not necessarily below 50. We can take advantage of those with some directional trades, but in the meantime kind of focus more on high probability trades and smaller trades just in case something comes out of the blue and sparks a higher level of volatility there. We don't get run over because we're so one-sided in the market to where now the pain trade is to the downside, at least for our portfolios. All right, so for today's trade idea, I want to take a look at a stock that we've been looking at actually in class. It's bouncing up here off of what was a light pink shading yellow line. Got a little dark pink here, but we've since bounced and breaking out today. Good market forecast pattern here with the intermediate line rising. But if you look at the Bollinger Bands, it's got a good pattern too. We're above the upper band here, kind of breaking out, which typically leads to a higher bandwidth to the upside, similar to something like this when you broke out up here and you made your way. We are breaking above this big volume node that we had pulled back down towards the bottom of. We're breaking out of the value area. If you take a look at it, it's got a really bullish pattern on its, whoops, not that one, on its DMI. Nice, good bullish pattern here with above 25 on the positive and back below 20, easily below 20 on the negative directional index, high ADX. If you look at its Ichimoku cloud, we had dropped below the blue line while being above the cloud. But now we're back, finally gotten back above the blue line here. If I get rid of these, I can get rid of these are drawings from a previous trade, but you can see getting back above the blue line with the green line getting close. So that's a good sign too when you had that pattern to bounce back up again and get going on a new trend. If you take a look at its long-term trend, you can see that after a couple bearish candles back towards the 50-day moving average after the golden cross, now we're back to a bullish candle, so a good pattern there. And then finally the 3 green arrow chart, you can see that after a convergence, and now we're getting what could be another divergence on the MACD, getting these to the upside after having a negative histogram here, negative momentum. We're turning back up and regaining some positive momentum with the buyers getting the kind of back in control here. So good patterns all around for the stock from all the indicators that we look at, which typically leads to doing a short put vertical spread. You can see the trade actually didn't go through today yet, and it's a relatively wide spread, so we have to keep that in mind. When we're looking for a $10 wide spread, it's actually gotten a little bit lower than what we were looking at before. So it's a relatively lower spread, a little bit below 30%. But it also, the nice thing about a $10 wide spread is with only doing one contract, it keeps my position size smaller than what I normally do, which is good because you want to keep position sizes smaller, and then we can try to go for that smaller reward again, and which means that I'm willing to lose $200, which I would lose if we were to break down below this Bollinger Band, this point of control, getting back below this little support level here. We'd have to get like to 285 for that to happen. So pretty good support that would help keep that from happening. All right, well, that does it for today. As always, thank you very much for watching. You've heard from me. I want to hear from you now. Use that link popping out in the top right corner of your screen. That takes you to our forums on marketscholars.com. You can open up any new thread there, ask any question, or post any comment you have about or reaction you have about anything we talked about in today's video, or for that matter, anything we didn't talk about that relates to what we've been covering here and what we cover day in and day out here. We can it's another avenue for us to keep this conversation moving. Again, thanks for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, and comment on our video. Follow me on Twitter for more content between the videos, and join our community at marketscholars.com and our Facebook group that we created for Market Outlook viewers. Have a great rest of your Thursday night, everybody, and we'll see you all next time.